dear friends of the conference. Welcome once again to our conference, virtual conference room. Let me first say how honored and privileged I am to be able to chair this session, which will cover a gamut of topics which lie at the intersection of, as the title says, corporate governance, finance, reporting, and auditing. I would also like to extend my warm greetings on behalf of the ICC Commission for Commercial Law and Practice, which I'm chairing at the moment. And as you know, ICC is one of the co-partners or partners of the conference. Today, we are going to spend some time together, so for the next 2 hours until 4 p.m. And first, we will have, of course, our panelists, and in the last 15 to 20 minutes, we will have, I hope, enough time to discuss all the pertinent issues that they will address today. I would also like to warn you, the speakers, about the time slots, which are allotted to each panelist, so approximately 50 minutes per speech in order to meet this idea of having a concise talk for 2 hours. Let me warn or ask all our attendees to turn off their mics during the session in order so as to avoid any kind of disturbance for the panelists. And actually, without further ado, I would like to introduce our first speaker this afternoon. It's my great honor to welcome Mr. Mate Trkanec. Mate is team leader for legal support in retail at Croatian Postal Bank, and he's also a PhD candidate in civil law at the Faculty of Law here in Zagreb. I was reading yesterday his abstract, and I could kind of epitomize it in 2 words: to fund and not to fund. Companies, according to their intention to meet certain carbon neutrality principles. And what is maybe even more important, Mate will talk a little bit about which tools, if any, banks should use to encourage companies to go more carbon neutral. So, Mate, the floor is yours, please.
Thank you, Christian. Thank you for this very kind introduction. I'm going to share. Please tell me if you can all see what I am sharing.
We see the preview. Now we need the full screen mode, which, yes, and yes, perfect, thank you.
Okay, so the topic today is going to be something called green credit, or the role of banks in facilitating carbon neutrality. So let's begin by just addressing the general acronym of ESG. It's environmental, social, and governance. We should never actually forget that environmental aspects of ESG are also incredibly important, just as the social and the governance ones. We've come quite a long way from ESG being a desirable business quality to becoming something that is almost a necessity in everyday business and everyday business decision making. Now, companies have to implement ESG. And in order for them to do that, they're going to have to change quite a few things regarding their corporate structure, document review, certain internal processes, internal documents, and so on and so forth, which essentially means they're going to need money. So what they can do 2 things. One, they can use their equity capital, which means that they have their own money to make those necessary changes. However, statistically speaking, not all companies have the necessary amount of money needed for that. So what they do is they go to something called debt capital. Debt capital is literally external financing, and it is in 99% of the cases related to bank loans. Now, in order for a company to actually get a loan, a company has to go through a process of a credit score calculation. Now, if we're talking about consumers, that's quite simple because there are laws that actually tell us what we have to look for. I'm talking about we because I work in a bank, so I'm a bank and so on. But here's the interesting part. When it comes to companies, when we are profiling companies, we are literally looking at two sets of facts, hard facts and soft facts. Hard facts are basically a company's lending capacity, its cash flow, and its net worth capital. Lending capacity is literally will the company be able to pay back the money that was loaned to them? Cash flow is pretty self-explanatory, but the net worth capital is actually mathematical equation in which you subtract the short-term debts from a company's short-term property and see if it's in positive or negative. So those are basically the financial indicators. But we also take into consideration reasons for a loan, company management, accounting transparency, risk indicators, so these soft facts. Sometimes these soft facts can have a much more powerful impact into deciding whether or not to credit a specific company. This is something the banks have been doing for quite a long time and are actually quite proficient in calculating companies' credit scores. However, when it comes to ESG, when it comes to carbon neutrality, we have to start by calculating a company's carbon footprint, which can be positive or negative. In calculating carbon footprint, we take into consideration three separate sets of elements. Environmental sustainability objectives, so how much is a particular company environmentally friendly on a general basis. Types of endeavors for which a credit is requested. So what exactly does he want to do? Does he want to invest in fracking, or does he want to implement solar panels? And the last part, management of environmental risks, which is a whole variety of elements that should be taken into consideration, primarily CO2 emissions, waste disposal, waste management, water usage, recyclability, land usage, and so on and so on and so on. So that's quite an extensive concept that we take into consideration. And by doing that, we have dual profiled a company with a credit score and its carbon footprint. Now, the important thing to notice is that a company's credit score and its carbon footprint are not mutually exclusive. Now, why? Because saying that a company's credit score is high means that it has a negative carbon footprint is a very false statement to make. If a company has a very high credit score, it can also be carbon footprint positive because it has better risk mitigation. Again, in certain empirical research and data, carbon footprint positive companies generally tend to be much more higher in their credit score calculations. Why is that? Because carbon footprint positive companies have a very wide variety of investment opportunities. They are much wider than, let's say, an oil company or, I don't know, a paper company or something like that. So basically, they have a wider field of investment, a large variety of goods and services that they can provide, and consequently have more customers. So we can actually step away from that fact that green crediting and green investments are not profitable. Recent economic studies show the exact opposite. However, there are profiling problems when it comes to carbon footprint profiling. Primarily, considerable resources are required for a credit institution to implement the necessary procedures and adequate taxonomy, which means banks are going to have to spend quite a lot of money to implement the procedures and the taxonomy for this calculation, and there is still no actual guarantee that the profile they will get is the correct one. Second, there is a general lack of client data relating to the environmental impact, which means companies are not very willing to give out those informations. What I have to say that in Croatia in 2023, there have been a significant evolution in this process because with the Croatian Credit Obligation Register in 2023, the main banks in Croatia have created a unified ESG questionnaire containing about 250 to 300 questions, which every company can fulfill, and it is online. And when they apply for a loan, the only thing that the credit institution has to do is literally download that ESG questionnaire. So a certain unification is in place. We just have to see how exactly it's going to work out when it comes to crediting those companies. But even if we have a unified questionnaire and unified information, there is always a possibility of different interpretation of those criteria, which means that one bank might say that a company is a carbon footprint negative one, while the other one could say, well, no, we're much more lenient and we deem this company carbon footprint positive. So banks are going to have to work with each other in order to obtain this sort of unified concept. Now, to credit or not to credit, that is the question, to say a Shakespearean quote. What we have to take into consideration is that the only thing that's going to make companies change their minds in going green is money. If we tell companies you're going to make less money than your competitors, or you're not going to make money at all, that is going to be the necessary and decisive factor for change. This is something that we have to take into consideration because gain and money is what drives companies, right? So banks have two options. One, they can credit a company and directly or indirectly harm the environment, which is something we want to avoid. Second, we cannot credit a company and potentially bankrupt it. Now, stick with me for a little bit. We don't give them the credit. No other credit institution gives them a credit. They don't get the loan that they need. They cannot make business investments. They cannot conduct their business. They cannot pay their debts. They cannot pay their workers. They go bankrupt. Okay? So we have very, very negative short-term social and economical repercussions of not crediting someone, okay? And the environmental impacts are still way, way further down until we see any applicable or any relevant effect on the environment. So what we have to look for is an alternative option, right? I believe that alternative options should be seen and should be found in the two main sources of income from credit institutions, and those are interests and fees. Now, statistically speaking, in 2023, the five main banks in Croatia have generated 1.8 billion euros from interest alone. In comparison, they have generated 458.8 million euros from fees. So, in my opinion, we should focus much more on interest. Now, what banks can do is if we have a carbon footprint negative company, we can literally raise the interest rates for a loan that they need. And we can differentiate interest rates for different companies based on their carbon footprint. Okay, so same market, competitors, one is carbon footprint positive, one is negative. The negative one gets a higher interest rate, and the positive one gets a lower interest rate, right? But how exactly is this decision legal? How can we actually say what we are doing is legal and get away with it? In order to understand that, we actually have to consider the fair open market and the free open market. We have to consider the rules of competition, right? Especially the EU open market and the EU single market. What we actually have to know is that there must be no obstacles hindering competition on a free open market. What we can have, we have rules that ease fair competition. What does that mean for national legislators? If they try to combat negative externalities and these negative concepts relating to environmentally problematic concepts, they can impose a fiscal solution, a Piguvian tax. Or they can say you will be much more liable, or you're going to have much more, I don't know, insurance relating to your investments. All of those solutions can be deemed as obstacles hindering competition from a national legislation perspective. So we have conflicting interests. We have a need for a fair open market, an abolishment of obstacles for a fair and free competition on that market, but we have to combat environmentally negative impacts of business decisions and negative externalities, while also having the right to a clean, healthy, and sustainable environment. So how exactly are you going to befriend those combating those conflicting interests, right? Here is something that's a neologism. It's called a social bank. A social bank functions just like any other bank on the market, but it takes into consideration ESG elements, not just the return and the interests of return, right? It takes interest and influences prices of carbon footprint negative companies. How does it do it? If I give you a loan that has the maximum legally allowed interest rate, your goods and your services are going to be at a much higher price. Consequently, your competitor who went green is going to have a much lower interest rate, which means its goods and its services are going to be price-wise much lower. So, mean more customers are going to gravitate towards somebody who has lower prices. That way, if you are putting a higher price on the money needed for your investments, you are consequentially saying your end product is going to be much more expensive. And in that way, you are literally using the market's own rules against carbon footprint negative companies. In conclusion, all companies should implement ESG into everyday business. Credit institutions should dual profile companies that apply for loans, and based on those profiles, they should determine which interest rate a company will be offered. With this way of doing business in the financial sector, credit institutions take on a new role as private law controllers of public interest. Now, allow me to end on a bit of a corny note, but together we really can't stop global warming. I'd just like to give you one more statistical data. This year, in 2023, Italy and several other European countries have found themselves at a necessity to delve into electrical energy reserves from the first time since World War II because of the excessive heat waves and the excessive air condition usage. Global warming is not something that is somewhere out there and we're going to have to combat it sometime in the future. No, we have to battle this thing right now. And I believe if we do not use the general driving factor for the companies who are responsible for global warming, we will not be able to do anything that is even tangible to stopping what is harming us in the long run. Thank you very much.
Thank you, Mate, for a really wonderful presentation. I would say groundbreaking and actually very interesting to see your thoughts about using interest rates as a kind of private law instrument in order to streamline kind of environmental goals. Quite interesting. Thank you for the presentation. We're moving forward with our agenda. Let me introduce you to our next speaker, our Italian colleague, Dr. Emanuele Stabile. He's a lawyer and assistant professor from Italy, focusing on specializing in company law and insolvency. Today, he will delve into the issues surrounding multitudinous self-reporting standards and reflect on the CSRD decision to introduce a single reporting standard. Without further ado, Emanuele, the floor is yours. Thank you for being with us, and we hope to learn a lot from you today.
Thank you. Firstly, let me thank the organizers of this conference, the chair of the program committee, and the moderator. It's a real pleasure, and let me say also a true honor to be here with such great scholars and such a great audience. Now, I will try to do my very best to respect the given time. Firstly, let me say that sustainability is at the center of the attention of the civil society, of the financial market, and the companies. Why? Civil society is interested in sustainability because it can result in better or worse environmental, living, and working conditions. Investors put capitals in sustainable businesses, and companies, as a consequence, are interested in ESG matters because being sustainable means for them raising financial resources, or better, raise financial resources in an easier way than other companies. And these can result also in an improvement of their image among the public. So sustainability is fundamental. It's fundamental not only for the people, but also for the entire capital market. So what is the question we will try to answer this afternoon? If we need a single reporting standard, and if this reporting standard has to be mandatory, or in some cases, it has to be adapted to the needs of the single company. And as a consequence, the second question is, do we need a sort of mandatory template for ESG reporting or not? The second question that is linked to these two I have explained to you is if sustainability reporting, or better, sustainability information is financial or non-financial one, which may seem something very theoretical and secondary, but is very crucial. Let's start from something that is very, in some cases, obscure, but it is also very important. That the companies started ESG reporting spontaneously in the late 70s of the last centuries. It was something they did autonomously because they found the importance of ESG reporting, but this caused that every single company used to do a sustainability report that was different from the others because it doesn't, it didn't exist a single reporting standard. These caused several differences between the reports and caused that what we call now the so-called greenwashing, because so many activities that weren't comparable adopted maybe the same standard or used the same key performance indicator, but this resulted in an ESG information that was unclear, obscure, and not comparable. Thus, the legislators started questioning if they could do something in this way. And the European Union took the lead of this action and started adopting some provisions. The first one, the most important in the recent time, is the non-financial reporting directive. Let me say that this is just the first one that has been followed by several other provisions. The last one, but we can mention some other provisions, is the Corporate Sustainability Reporting Directive. Firstly, before entering into the juridical aspects of this phenomenon, we have to be very clear on what is corporate sustainability, corporate social responsibility, sorry. Some scholars argue, and I'm reading this, is the voluntary integration of governance, social and environmental content in business activities and in their relations with other parties. So it is a social phenomenon that arises from civil societies and that we try to regulate. But it has not been so in the past because this movement, this attempt to regulate corporate social responsibility and, as a consequence, ESG reporting started in the late 80s. Because before, when there was the shareholder value paradigm, companies management had a very short-term time horizon and the ESG reporting was not widespread. Then there was a change, a sort of introduction to new paradigms, the so-called stakeholder value paradigm, and companies started ESG reporting. Now, what is very important? Bear in mind this historical origin of the phenomenon. The European legislator required public interest entities that we can define as large companies to publish a non-financial declaration containing at least environmental, social, personal related, human rights related information. Obviously, the content of ESG reporting is much more broad, but this is the very central core of the team. Obviously, the non-financial reporting declaration didn't opt for one single reporting standard. So companies were free to choose among various reporting standards. They could choose the Global Reporting Initiative standards or the UN Global Compact standards, but these are just two examples. This means that another time we could have problems in ESG reporting because it resulted in a violation of some criteria that are the very basis of reporting. I refer to necessity, relevance, clarity, completeness, and comparability. Moreover, the non-financial reporting directive didn't impose a template. The Corporate Sustainability Reporting Directive instead introduced a template. This template is not mandatory, so pay attention to this. We don't have a mandatory template, and moreover, the directive states that ESG reporting can be introduced in management report attached to the financial statement, or it can be a separate document. Why? Because sustainability is not something we can reflect in just numbers like for the financial statements. So it's impossible, and a lot of scholars argued about this. It's impossible to summarize this information only in numbers. We have to take into consideration the differences among the various companies. And to do this, we can't impose them to use one single reporting standard and one single reporting template. And also for this reason, if we go to the European Sustainability Reporting Standards adopted by the European Commission, yes, they set a lot of principles. They provide for general principles, criteria on specific economic sectors and subjects. But above all, the general rule is that companies have to comply with these criteria or explain why they don't do it. But they have to choose what key performance indicators, and they have to select the best information that they think they have to summarize and expose to the public. Why I'm telling this? Because sustainability information has a very strict link with financial information. In fact, if we think to the investment relationship, it is characterized by a very famous information asymmetry on the parties. The investor lacks the information available to the counterparty, and so all the legislators adopted for disclosure duties on the other party, which usually are large companies or banks. So what is the idea after having one reporting standard? Giving companies an input about what KPI, what information disclosed in order to avoid information asymmetry. And this is probably the best proof of the existence of a link between financial and sustainability information. It is probably the best definition instead of using non-financial information, because recital 8 of the Corporate Sustainability Reporting Directive states clearly that this information has a financial value. But the importance of having one single standard is clear also if we think about ESG rating. We all know what is a rating. It is a sort of synthetic judgment that certifies the solidity or profitability of a company, an asset, or something similar. But the rating is calculated on the basis of the information that the company gives to the agency rating. And if we look to the everyday practice, well, we can note that there are a lot of products, a lot of companies that are rated differently from agency ratings, not only because they use different metrics, but also because they give different information basing on the reporting standard they choose. So what is, and I'm going to the conclusion of my intervention. What is the conclusion? Well, we need having one reporting standard, but this reporting standard, in our case, the European Sustainability Reporting Standards, have to be not binding. We have to bear in mind that these standards have to be adapted to the specific entity reality. Because if we have only a mandatory set of standards, well, we can have some very strange effects. Think about industrial players and financial players. For example, in one case, using a KPI, for example, the reduction in waste, the reduction in pollution is good. It measures the impact of the company, on the environment. But for example, for a financial institution, this is not a good way to measure what the impact of this company is on the environment. So, and this is not only one of my ideas, we should have a reporting standard, but this should be also adapted to the reality. And the same is for the reporting template. Yes, we can have a reporting template, but if we look also to other laws and regulations like capital requirements regulation number 2 for the banks, prior to the corporate sustainability reporting directive, there was a template, but this template was not defined binding because it has to be adapted to the single entity. And the final point we can summarize from this speech is that sustainability information is truly financial information because it drives the allocation of resources in the capital market. So we can't continue talking about non-financial information. And this is just the final word of my intervention, and I want to thank you for your patience and for your attention. Thank you.
Thank you, Emanuela. Thank you for your presentation. I couldn't agree more. I really like your critical, you're casting a critical outlook on the single reporting standard, this one-size-fits-all agenda. I completely agreed with the idea that not every company could fit within the same kind of standards, and that we should think about different standards for different companies. So thank you for this remark. Moving on with our agenda, and as I wrote down in the chat box, please feel free to post any questions, comments you might have via chat box. We will discuss them later on at the very end of our session after the panel. I see Anna is ready, steady. Thank you. So our next speakers, third, are Ana Jovita and Boris Tušek, both professors of accounting and auditing at our home institution, the Faculty of Economics and Business, University of Zagreb, and they both specialize in financial statements and internal audit. And in line with that, or against that backdrop, they will speak about corporate governance, notably those tools like external audit, which might foster accountability, and they will specifically reflect on earnings management. So we will hear more about this interplay between external audit quality and earnings management. Anna, Professor Tušek, the floor is yours. Thank you.
Hi to everyone. Thank you, Christian, for a great introduction. Firstly, we would like to thank the organizers for opportunity to participate at this conference. As Christian said, my name is Ana Jovita, and I will today present the paper prepared in co-authorship with Professor Boris Tušek regarding the topic you can see on this title slide. We will talk about audit quality and the relation to earnings management. The objective of our research, as you can see from the following slide, is to investigate effects of internal audit quality on earnings management intensity. So to conduct this research, we prepared some conceptual model, which you can observe from on this slide. On the one side, we will talk about measurement of earnings management, and on the other side, we will try to measure audit quality, and we will try to relate those two variables in context of our research objective. So firstly, to be able to conduct the research, we had to gather the data. So our initial sample was focused on the companies that was listed on Zagreb Stock Exchange in 2024. There were a total of 86 companies. According to the differences in financial reporting structure of the statements, we excluded the financial institutions, and additionally, regarding a non-financial institution, we excluded from the sample all those companies for which we didn't have more than 5-year observations. So finally, our sample included a total of 69 companies, and we gathered the data, financial data and data from auditors' report for the period from 2015 to 2023. Year 2015 was used only for logging purposes to create legal variables constructed on financial data. So at the end, we observed a total of 545 auditors' report, and our final sample, as you can see, includes 69 companies and 521 observations. Considering that we don't have data for all companies for all 9 years, our data is unbalanced panel data. So here are some basic statistics on our sample. As you can see, for most of the companies, we managed to gather all needed data, more than 90% of them. Additionally, majority of companies are from tourism and food industry, and they are located in the city of Zagreb or Mediterranean Croatia. It is interesting to notice that those companies in 2023 year employs almost 88,000 employees. Their total assets value was almost 22 billion euros, and they generated almost 60 billion euros of revenue. So these are the basis for our research. Furthermore, we had to determine what audit quality is. In that context, I believe you are all familiar with the term financial statements audit and purpose of financial statement audits. Auditors need to express an opinion if financial statements represent fair and objective representation of financial position, business performance, changes in financial position of the company. So how to measure quality of these audits? It can be observed from different perspectives. Firstly, we can measure quality as ability of auditors to discover a breach or some misstatements in financial statements, or from the other hand, we can observe it as effectiveness of audit performed efficiently, timely, for a reasonable fee. In that context, the standard setting body issued 2 standards related to audit quality, issue a framework for audit quality, but didn't provide any concrete quantitative measure for measuring audit quality. It only represents some factors that are important to ensure quality of auditing. On the other hand, when observing previous studies, we noticed that majority of researchers used one proxy to measure audit quality. It is the size of audit firm, which is presented if audit company is a part of Big N. Previously, it was Big 8, Big 6, Big 5. Now currently is Big 4 companies for auditing financial statements. In addition to this factor, as you can see, many others are used to measure quality of auditing. Nevertheless, it is important to emphasize that audit quality is a very complex term, and there is no universal measure to measure it, how high quality is. We try to complicate things a bit, and we try to create audit quality proxy, which includes, as you can see from this table, number of variables. Of course, this most used Big 4. In addition to that, audit market concentration, if the audit was joint audit, duration of the audit tenure, if there is a first appointment, industry specialist. In addition to that, we tried to measure quality of auditor's report by including 3 variables: numbers of page in auditor's report, if they reported about materiality details, and the numbers of key audit matters reported. So all together can be presented in this model, how we calculate our audit quality proxy. And furthermore, here in this slide, there are some statistics very basic about these variables. Maybe the most interesting graph on this slide is these differences in a number of conducted audits between 2016 and 2023 between Big Four and other auditors. We could emphasize this BDO, which is not part of Big Four auditors, and increase its proportion in total audit conducted in last observed years. This is not unique years in observation. The trend over the years is really it's concluding in last observed year. So results of our audit proxy is, as you can see on this slide, here in this graph, you can really see the difference between values of audit quality between Big Four companies and other companies in mean, mode, and median value. We tried to classify this audit quality proxy value in some levels. So we classified it in 5 classes, as you can see on this right part of this slide. It is maybe important to emphasize that maximal theoretical value of our audit quality proxy is 5. And as you can see, neither report doesn't have maximum value. The maximum value of auditors' report quality was 3.72. And it's the value of some perfect conditions. So to move on, other variable that is important for our research was, of course, earning management. This variable is well investigated in previous studies. So we used already constructed model. It was firstly introduced by Jones in the early 1990s. He stated that earning management can be measured by total accruals, which are actually the changes in working capital and from balance sheet and depreciation amortization costs from income statement. In addition to that, those total accruals can be divided in non-discretionary and discretionary accruals. Non-discretionary are those accruals who are not controlled by management. These are consequences of business activities and economic conditions. On the other hand, discretionary accruals are controlled by management, and they are a result of accounting policies and statements of the management. So in this part of accruals, there are possibilities for manipulation in financial results. To calculate these discretionary accruals, we used modified Jones model. There are many models on this topic. We tested it on many other models. This model shows us the greatest robustness and best results. So this model results in residuals, which actually represents this non-discretionary part of accruals. And when we subtract those non-discretionary part of accruals from total accruals, we obtain the result of these discretionary accruals, which can be manipulated by management. So these are some results of this earnings management proxy. As you can see, this is the interesting graph where in 2020 we have some differences as a result of COVID crisis, and in the following years, of course, we have also some changes as a result of changes in economic conditions, especially inflation in Croatia. What we did, the following, we divided this earnings management proxy into 3 classes as neutral, no earnings management, negative, where the result of earning management is decrease of the profit, and positive, where the result is increase in profit. So as you can see, the most Croatian companies have negative discretionary accruals, meaning that they affected profit in decreasing way. So finally, our research results includes testing of 2 research hypotheses. First, as you can see, we tested if higher audit quality is associated with lower discretionary accruals. And to test this hypothesis, we used fixed effects model, which was the result of conducted test that is the best fit for the data. And as a result, we have that result which indicates that increase of audit quality proxy for one actually results in decrease of discretionary across. However, this variable is not significant in the model with what you can see here in this table. So we are, in that case, wasn't able to accept this first research hypothesis. On the other case, we investigated if auditor's opinion is more often modified in case when discretionary accruals result in decreasing profit. In this case, also fixed effects model represent best fit for the data. And in this case, you can see that audit opinion is when is modified, discretionary accruals are more negative. What is actually supported by previous results, you can recall that more than 80% of observation have negative discretionary accruals. And in this table, you can actually see that if opinion was modified, which was the case for 93 auditors report, there is actually higher discretionary accruals compared to the companies, to the auditors report where the financial statement didn't have modified option. So what to conclude finally on this final slide, maybe auditors in Croatia are not effective enough in detecting earnings management, or they are responsible for their creation. It can be observed also in this direction through request for value adjustment of different items in balance sheet. However, they will express modified opinion in case of significantly negative discretionary accruals. Furthermore, on the scale up to 5, the average audit quality in Croatia is 1.46, median value 1.27. And indeed, big auditors have a higher score compared to others. However, we have to be cautious with this conclusion, taking into account that Big 4 is a variable for calculating audit quality proxies. So if we modify that proxy, they are by mean value, they are similar in quality. However, observing median value, still Big 4 company have a higher audit quality. And finally, final conclusion, Croatian companies during the observed period more often use earning management to decrease earnings rather than increase it. So I try to be very fast to be in a time frame. Hopefully I didn't miss it too much. I will like to thank you for your attention. Hopefully this was interesting for you, and if you have any questions, feel free to ask. I will try to answer them. Thank you.
Thank you, Anna, very much. All of you have perfect timings. I'm very happy to be able to say that. Thank you for your presentation, whereas it's very complicated for me as a lawyer to comment on the empirical results emerging from statistical analysis. I'm always, on the other hand, very happy to see some tangible empirical results when we speak about CG. But of course, we'll have time to comment on these results a bit later. Moving on with our agenda, let me welcome our colleague from Italy, Ms. Clara De Cirico. She's a PhD candidate in law at universities of Ottawa, Canada, and Macerata, Italy, focusing on director's duties and liabilities concerning local communities in Canada and Italy. So today we have a comparative overview of these two jurisdictions. Clara will address us with a very interesting, in my view, also maybe a bit bold, but I'm very happy to hear more, proposal to replace the economic analysis of law doctrine currently permeating Italian corporate law doctrine with a more sustainable and inclusive theory of the commons. Clara, please welcome. The floor is yours.
Thank you very much. I hope you can see my slides.
Yeah, perfect.
Okay, great. Yes, so my presentation today is entitled Rethinking Corporate Law in Italy. I'm actually not doing a comparison today, so I'm focusing a little bit more on Italy. But so essentially, the focus of the presentation is to discuss the limitations of the economic analysis of law, also called EAL in Italian corporate law, and to propose a possible alternative that is based on the theory of the commons, as this could be a little bit more stakeholder inclusive than EAL. So the starting point of the presentation is to highlight that large corporations can harm local communities and other stakeholders by threatening essential resources on which they depend, for example, water, land, air, and so on and so forth. We may make several examples. I have included a few examples in this slide from Italy and around the world. For example, corporate emissions can create extreme weather events. I mean, they can contribute to those. There is the possibility to have industrial disasters, but also to pose risks to biodiversity, for example, in cases of extracting activities. So while legal tools are important for promoting corporate accountability and for protecting community interests, at the moment, corporate law in Italy has traditionally been shaped by an economic reading. And this reading has essentially prioritized the shareholder welfare over the consideration of other interests. So the aim of this presentation is to see whether there are any alternative approaches, not to completely replace the economic analysis of law, but at least to address this limitation that it has on protecting stakeholders' interests. So in this slide, I have included some points to show how the EAL essentially is embedded in corporate governance in Italy. And the main point is the interpretation of Article 2247 of the Italian Civil Code, which states that profit is an essential element of corporations, so it is a key element of the corporate contract. The problem with this provision is that it has often been interpreted as a provision requiring directors to maximize shareholder value. It is debatable whether this should be done in the long run or not. At the moment, it is argued that at least listed companies should pursue shareholder value in the long run because of a modification of the corporate governance code in 2020. Anyways, the point is that other shareholders' interests are considered external and not directly relevant to corporate governance. And this viewpoint, this approach has also shaped the scholarly debate because the discussion has prominently focused on preliminary issues to stakeholder protection, and specifically the point of whether the duty of loyalty should include only shareholders or also other stakeholders. So essentially to see if directors are responsible for providing benefit to other stakeholders other than shareholders. So this approach is grounded in some neoliberal postulates. This is what a famous Italian scholar De Nozza has argued. So there are some neoliberal postulates that have provided support to EAL in Italy. And these are market fundamentalism, the idea that the corporation can be read through a principal agent model, the idea that shareholders are a homogeneous group because they are all welfare maximizers, and also the idea that legal problems can be read as efficiency transaction problems. And these postulates have shaped how Italian corporate legal framework has developed, and also how research has been conducted. So essentially, this has favored market efficiency and shareholder welfare over other environmental and social concerns, creating a challenging environment for stakeholder claims in corporate governance, essentially because stakeholders are marginalized, they are generally without legal recourse, and also directors' duties are framed narrowly to pursue shareholder value and shareholder profit. So a possible alternative to this approach, I think, could be the theory of the commons, which is an economic and legal theory that emphasizes shared management of resources and community interests over individual interests. The theory of the commons has been first proposed and developed by the economic scholar Elinor Ostrom in the US, and she demonstrated that local communities can effectively manage common resources under certain circumstances, arguing that privatization of resources is not always the optimal solution to crowding effects and overuse, which are the collective action problems. In Italy, the TOC has been developed in the legal field, essentially by Stefano Rodotà and Ugo Mattei, and we can define commons from a legal perspective as resources that are essential for exercising fundamental rights and for enabling human development. At least this is the definition that a committee led by Stefano Rodotà gave of commons in 2007 for the modification of the civil code, but this bill was never applied. So the taxonomy of the commons is an open taxonomy because we cannot we cannot make a list of commons because, of course, they depend on the changing needs of people and communities. But what is important is to highlight that to exercise fundamental rights that are, of course, connected to the idea of commons, this should have certain characteristics, and specifically they should enable users to access and enjoy these resources, also when they are not the owners of the resource, and to allow for participatory governance. In this slide, I wanted to frame my research within previous literature, and essentially I would like to highlight how my research differs from previous research, essentially from Deakin's research, who has studied the TOC and has proposed to apply the commons framework to the corporation, essentially to understand corporations as commons, where there are multiple stakeholders, and these stakeholders have participatory claims to the resources that are produced by the company. Essentially, in my from my point of view, the commons are not like the commons framework should not be applied to the corporation itself, but I conceive of commons as natural resources, and community rights are not participatory rights, but right not to be harmed by the business activity. There have also been previous attempts to integrate stakeholder interests in corporate governance, mainly through stakeholder theories, which developed at the end of the last century and critiqued the traditional economic focus of shareholder welfare. And essentially, stakeholder theories were based on efficiency arguments and relied on voluntary implementation of stakeholder-oriented management practices. The difference between stakeholder theories and the TOC is that the TOC establishes that communities are relevant because it proposes a reconceptualization of ownership rights. And it is also based on constitutional principles, constitutional rights that are the right to a clean environment, and social utility that limits private property, and also the principle of solidarity. So essentially, the problem is to think about how may the TOC mitigate the drawbacks that are created by EAL for stakeholder protection. So the first drawback is created by the neoliberal postulate of market fundamentalism, and essentially lies in the diminished role for collective stakeholders in corporate governance, because market fundamentalism essentially focuses on individuals as on individuals as better actors than communities in the market. So the theory of the commons may mitigate this drawback by legitimizing community interests in corporate governance, essentially by providing a framework where communities and corporations are both users of the same resources. So essentially, they both have rights and obligations towards each other because they rely on the same resources. The second drawback is created by the principal agent model of the corporation, which essentially posits the idea that corporations are based on a contract, but this, of course, creates agency problems between directors and shareholders. And so essentially, in order to mitigate these agency problems, directors are asked to pursue shareholders' interests. A possible way to address this issue through the TOC is to reinterpret the ownership of shared resources, of commons, and this reconceptualization, reinterpretation should impact how the relationship between the corporation and communities is conceived, because it would reshape the director's duty of care, essentially not by asking directors to benefit other stakeholders other than shareholders, but by imposing an external limit that should be assessed through the concept, the criterion of social utility. The third drawback is the homogeneity of shareholders, the conception of shareholders as rational welfare maximizing agents, which essentially leads to consider other external stakeholders as dishomogeneous groups. So the problem here is to find similar grounds for stakeholder groups to claim that they can also be homogeneous. And I think this could be done by finding a legal structure for stakeholders, which may help them to organize their interests and make them more homogeneous to be considered by corporations. The fourth drawback is the idea that legal problems could be reduced to transaction efficiency problems. And perhaps this drawback could be mitigated by the TOC, which calls attention to integrating fairness as an additional criterion to efficiency for evaluating corporate governance. Essentially, the problem here would be to determine what is fair, and this could be done by, again, drawing on constitutional principles of solidarity, human dignity, and environmental protection, but necessarily this could also should also be operationalized in the corporation and in the management. So, of course, this poses important questions for the interpretation of fairness. So to conclude, the economic analysis of law poses some limitations for the protection of non-shareholder stakeholders, and this would call for a shift in corporate governance theory. This shift could be based on the theory of the commons, which may offer a different and more inclusive framework for balancing corporate interests and community welfare. How we can apply the TOC. For example, the TOC could be applied through a reflection on the reinterpretation on directors' duties, and specifically the duty of care, to include social utility as a limit to directors' discretion. Of course, to implement the TOC in Italy, it would be helpful to have a formal recognition of commons in Italian law, because this, of course, could facilitate the interpretation of other corporate law. Further research ideas include, for example, addressing enforcement issues. Of course, if we claim that communities should be protected, this also goes with the enforcement mechanisms, essentially, which should which should improve access to justice for affected communities, and also tackle the drawbacks posed by the business judgment rule to directors. And also it will be necessary to address the challenges, again, as I was mentioning before, related to determining fairness in corporate management, both ex ante, so in the moment when directors should understand what is fair and what they should do, so which decision they should take, but also ex post in legal proceedings, to determine if there was a unfair harm which entitles communities to redress. Thank you very much. I hope you enjoyed the presentation, and I'm open to answer your questions if you have any. Thanks.
Thank you, Clara, for a wonderful presentation, for this theoretical inquiry into the law of commons. And I hope we'll have some questions and comments later on. For sure, I will have some. Let's move on with our agenda. We're still good. Let me greet Dr. Sava, Rafael Sava, from senior lecturer in law at Lancaster University, UK. Rafael focuses on business and sustainability issues in the wider context of corporate law, and he will deliver a presentation tackling possible avenues, if I understood well, of reforming EU sustainability rules that could streamline adoption of the double materiality-minded engagement practices, with particular reference to institutional shareholders. Rafael, the floor is yours. Thank you.
Thank you, everyone. Can I just check that you can hear me well?
Yes, we hear you perfectly.
Excellent, excellent. So let me just share my screen. Okie doke.
Yes, we see it. Nice.
Super. Thank you, everyone, and I apologize for my voice if I sound a little bit groggy or if I cough along the way. Unfortunately, sickness has caught up with me. But thanks, everyone, for this conference. It's definitely an experience that I have learned a lot from. So, today is about a paper that it has transformed into some form of a scoping exercise that has led to informing a couple of future projects that I'm currently working on. But I thought that this paper was the necessary evil, so to say, in order to develop or create the establishing context behind the development of those projects that I'm currently working on. And it relates fundamentally to the fact that in the context of introducing its renewed sustainable finance strategy, the Commission announced that it will review the frameworks that govern stewardship and engagement practices, and in particular, the Shareholder Rights Directive 2. And according to the Commission in the Sustainable Finance Strategy, the goal is to determine the possibility of amending those regulations in order to echo the EU sustainable objectives better. Now, the Commission didn't go into much length into explaining its position as to what it meant by this, or provide any context as to what it wishes to do exactly. But to me, there are two inferences that can be made out of this statement and the announcement in general. That most likely the Commission envisions engagement practices from shareholders, especially institutional shareholders, to be permeated by the idea of double materiality, that whole imperative that the Commission longs corporates as well as financial institutions to be following, and that the Commission may be planning, through reviewing the law, to sort of instrumentalize the law to stimulate the governance and undertaking of those engagement practices as permitted by double materiality, which I tend to call in my paper and in this presentation as double materiality-minded engagement practices. And along the way, when I was reading the sustainable finance strategy, it inspired me to look into the extent to which the law as it stands is capable of stimulating the governance and undertaking of double materiality-minded engagement practices. But in my paper, I sort of focused into the laws of those frameworks that essentially deal with regulating institutional shareholders for the governance and undertaking of their engagement practices, to see the extent to which they are fit for the purpose of steering them towards that direction or not. And as a general argument, I posit that possibly if the Commission would like these laws, especially the laws that deal with institutional shareholders, to be a lever by which they would steer institutional shareholders towards undertaking and governing double materiality-minded engagement practices, that possibly the Commission should recommend reforming the law. But me saying that is the easy part. I would think that any attempts to reform the law and any tampering of the law should be made prudently and with extreme care, because there is a need to either introduce or govern the standards and criteria for what double materiality-minded engagement practices are. And if there is going to be any attempt to review the law, any review of the law and reform of the law should lead towards engendering the channels by which institutional shareholders will be capable of appraising the governance and undertaking of double materiality-minded engagement practices. But I'm getting a little bit ahead of myself, because the reality of things is that the law in question, as is, indeed strives to sow the seeds for institutional shareholders to at least reflect on the treatment of engagement practices as it relates to utilizing them and governing them to promote responsible business. I think we know all these laws. They have been around for some time. They're mostly found in the Shareholder Rights Directive 2, in Articles 3G, 3H, and 3I. That their majority, they are disclosure requirements and a number of procedural rules that come along with them in terms of developing an engagement policy for how institutional shareholders are integrating engagement practices into their investment strategy, how elements of their investment strategy are consistent with the clients and beneficiaries' liabilities, as well as the performance and contribution to the medium to long-term performance of the assets, et cetera, et cetera. But we also have a number of voting strategy requirements for certain institutional shareholders that the SRD2 is touching upon in relation to UCITS and AIFMs. And although these laws do not create a duty to engage, they do create some form of implicit normative expectations as to what is actually expected of institutional shareholders to be doing. And I would argue that these are for institutional shareholders to at least consider whether to engage and show that they walk the talk of what they state in their own disclosures by actually undertaking and governing engagement practices, to adopt specific engagement practices such as monitoring investee companies in relation to the impact on the environment and the society, as stated in Article 3G. The use of engagement practices to improve companies' medium to long-term performance, that is mentioned cordially, not only in Article 3G, but also in Article 3H with regards to the incentives that asset owners are giving to asset managers, the kind of incentives to do so, and engagement practices to be part of investment strategies that are executed for the benefit of the clients and beneficiaries, but also that they contribute to the medium to long-term performance of the assets. And along the way, we see phraseology being used in relation to be mindful to the environmental impact of companies, the social impact of companies, etc. And so, to me, at least, I do see the law as is, sowing the seeds for institutional shareholders to at least reflect on the treatment of engagement practices as it relates to issues related to environmental, social, and governance considerations, etc. But in addition to that, if we just broaden the scope for a moment and we look at the positioning of these laws in interaction with broader sectoral law, specifically EU sectoral law, we can see that sectoral law can have the ability to influence the undertaking and governing of engagement practices that are concerned with these issues as well. And that is especially true after the introduction of the sustainability financial disclosure regulations, the taxonomy regulation, the amendments made to sectoral law in terms of introducing sustainability risks and factors. Again, the law here is not extremely perfect. Like fiduciary duties, for example, are mentioning different parameters and they are having different standards imposed now, thanks to all the amendments that have been done. For example, for pension funds, there is a mention of environmental, social, and governance considerations to be taken into account, whereas other regulatory regimes are mentioning only sustainability risks, or they have a combination of mentioning sustainability risks and principal adverse impacts on sustainability factors. We have EU sectoral law governance regulations that are touching on a number of issues that have to do with taking into account again sustainability risks as part of organizing their own business, etc. And we also have the plethora of disclosure requirements that the SFDR and the taxonomy regulation has introduced in relation to financial institutions. And what was interesting to see in the SFDR was that in recital 18, it was stated that the information disclosed may describe the way that sustainability-related stewardship responsibilities or other shareholder engagements are discharged, which to me, it feels like there is a flimsy sort of implicit expectation that all these laws are expected to develop disclosure that in some form or another would provide information as to how engagement practices are utilized towards this and towards promoting or touching issues related to ESG considerations. Now, although this is the state of the law, I do not think that the law as is can effectively direct institutional shareholders to govern and undertake double materiality-minded engagement practices. And before me answering as to why I think that it is, I think it's important to take a step back in order to understand what it entails for institutional shareholders to undertake such practices. Well, first and foremost, we have no tangible understanding as to what double materiality-minded engagement practices would be, or who would set that standard to even begin with. Is it something that is related to anything environmental? Does it cover addressing negative issues? Does it cover addressing positive issues? That is something that is a little bit murky, and some form of direction would have been appreciated on the Commission side. But in addition to that, there are a number of other considerations that may make the undertaking and governance of double materiality-minded engagement practices a little bit making them a little bit difficult or hard to implement, or possibly to witness them anytime soon. It comes with in relation to what double materiality stands in relation to the whole concept. Although we have an idea as to what it is, it's not tangible in one way or another. There are issues in relation to utilizing metrics to conduct such engagement practices. We don't know the extent to which institutional shareholders have the know-how or the availability of resources in order to undertake that. And of course, these are coming on top of the standard institutional shareholders incentives, which the literature has been so much debateful in relation to the incentives of specific institutional shareholders to fit the bill of the so-called responsible shareholder engagement attitude. But me saying that is nothing that the Commission or EU regulators are not knowing, because EU derived law, and especially the one that I have examined in my paper, was enacted in cognizance of the majority of these issues. Yet the way these frameworks seek to address them is indirect, is through disclosure and transparency and the development of policies. There is this thinking that there will be some stimulating of self-regulation and market regulation that would automatically solve these issues. And although I don't think that self-regulation and market regulation are doomed to failure in any way whatsoever, I think it is unlikely, at least at this stage, that such initiatives would transpire to the point where they will enable the governance and undertaking of double materiality-minded engagement practices, without having considerable changes in the structures that guide institutional shareholders' treatment of engagement practices as they are at the moment. And that is for a number of reasons. The first one is that for even if we assume that we know what double materiality-minded engagement practices might be, the undertaking of them will entail some form of cost in terms of getting the know-how, getting the people, possibly getting a number of institutional shareholders or other shareholders together in order to collectively engage with certain companies, depending on the situation and the severity of the issues. And certain institutional shareholders may just not have the incentives to do that, either because that they lack the resources, or their investment strategy or business models are just simply not fitted in order to undertake in order to fit this undertaking. And although this is a contestable argument to be made, because again, the literature is suggesting that actually specific institutional shareholders may have the ability to undertake them, but possibly they may not undertake them for a number of other reasons. The question again remains as to the extent to which, even if such institutional shareholders would have the incentives to engage with companies, whether they would engage with adopting double materiality-minded engagement practices to begin with. And in addition to that, there is that idea of market regulation that possibly could solve these issues, and possibly in the future it would. But at the moment, I cannot see, at least personally, and I could be wrong, I cannot see personally as to how this is going to be conceivably possible, because at least a sizable share of those people who may be interested in policing that are clients and beneficiaries. And although clients and beneficiaries show at the moment that they're interested in all things environmental, social, and governance considerations, it is difficult to know if that desire would translate also to a desire for engagement practices to the point of then demanding it from institutional shareholders. Possibly there can be some form of demand in terms of the contracting between asset owners and asset managers, but that is something that needs to be tested moving on. And in addition to that, we need to take into account other considerations in terms of the investment intermediation, etc., which may complicate the ability of any voices or any demand for double materiality-minded engagement practices to channel through to the institutional shareholder who is indeed capable of engaging with investing companies. So there's that. And the other one is that even if we have some form of changes in the structures, I do not think that these changes are going to work together in order to promote the idea of governing and undertaking double materiality-minded engagement practices if there are no changes in the normative imperative about them in the law, accompanying them in one way or another. But I need to be clear on a specific thing in relation to that, because this could be taken a little bit as controversial. And I do understand that it sounds a little bit controversial. For the simple reason that my examination, at least in my paper, of the law when it comes to what the law actually considers as permissible for the content of engagement practices, finds that actually something like undertaking double materiality-minded engagement practices can be accommodated and can be seen permissible. They can follow with the so-called fiduciary duties of institutional shareholders towards clients and beneficiaries. The EU regulator, in adopting all these regulations, indeed had some form of intention not to constrain that kind of ability in order to be a possibility. And a careful reading of recitals, etc., could lead towards having that conclusion. And I don't think that the provisions of the Shareholder Rights Directive in terms of improving the medium to long-term performance of companies, whether financial, non-financial, or the medium to long-term performance of the assets, are detrimental or go antithetical to promoting double materiality-minded engagement practices or undertaking them.
Rafa,
However,
sorry, if you can wrap it up a little bit, we are out of time. So if you can wrap
whoops.
your presentation.
Okay, so I'm just wrapping up my argument now. Is that okay?
Thank you. Appreciate it.
Yeah. So I do not think that this is going to essentially, although they are permissible, I do not think that the moment that there will be some consideration as to whether they're compatible or not, that they are actually clearly permissible, or they can be going through the interpretation process of institutional shareholders in a seamless way. And therefore, I think that the way forward is to possibly for the Commission to recommend adopting some decisive measures that could clarify the position of the law in relation to these issues, in addition to introducing certain measures that could possibly stimulate the governance and undertaking of double materiality-minded engagement practices. And I would say that a good shout for the Commission would be to review the SRD2 and other frameworks, as it has announced at this stage. I should possibly consider introducing some standards and criteria and procedural requirements that touch on a light touch basis on stewardship teams in terms of setting, based on a qualified basis, a number of criteria for stewardship teams in terms of what they can and cannot do and what they should be mindful of. But in addition to introducing some programs that may stimulate experimenting with double materiality-minded engagement practices. But unfortunately, I don't have much time to deal with the experimentation, but I'm really happy to take on any questions and elaborate further. So thank you for your time, and apologies for breaching my own timeline.
Thank you, Rafael, very much for a very interesting topic. I hope we'll have some time at the very end to discuss all the pertinent issues concerning the double materiality standards. Moving on with our schedule, I'm happy to introduce our second to last speakers today. I see Ana Maria Ijotic, she's here. She's going to present her paper together with Professor Darko Tipuric and our colleague, Dr. Alana Cindric. Few words about our speakers. Professor Tipuric is a full professor of organizational management here at the Faculty of Economics and Business. He's also an incumbent president of the Croatian Association of Economists. Dr. Alana Cindric is a senior lecturer also here with affiliated to our faculty, and she's focusing on board dynamics in her research. And our speaker today, Ana Maria Ijotic, she's a part-time lecturer in organizational management, also affiliated with our faculty, and sales manager at a company here seated in Croatia. They will cast a comparative outlook in their presentation on anti-corruptive guidelines across corporate governance codes in different EU member states, and they will shed some light on commonalities, variations, and overall efficiency of these guidelines at company levels. Ana Maria, the floor is yours. Thank you. Please, 15 minutes sharp.
Thank you, Christian, for this warm introduction, and thank you to all organizers of this conference for the opportunity to present our paper. Our research was conducted at the Faculty of Economics and Business at the University of Zagreb, and this paper undertakes a comprehensive comparative analysis of anti-corruption guidelines which are embedded within the codes of corporate governance in European Union member states. With a specific focus on the realm of corporate governance, our analysis investigates the extent to which these codes directly address key dimensions of anti-corruption efforts. So first, I will start with the significance of corporate governance codes as a soft law approach for achieving better governance practices, and then I will also mention the role of these codes in combating corruption within corporate governance.
And then finally, the central part of this presentation will be the results of our research, the findings, contributions, limitations, and opportunities for further research. In response to the institutional crisis in 1998, the European Commission set off a comprehensive discussion about enhancement of corporate governance systems within the European Union. And in the past decades, the EU has been focused on developing a regulatory framework which relies on alternative instruments which serve as an addition to traditional law. These alternative instruments, codes of corporate governance included, are often referred to as soft law, self-regulation, or co-regulation. Corporate governance codes are crafted to address the deficiencies in corporate governance systems, and they are sets of recommendations on best practices in various aspects of corporate governance, such as shareholder relationships, top management transparency, board composition, and many more. The application of codes of corporate governance varies across member states, and while some companies adopt them voluntarily, others do so to comply with national law or stock exchange regulations. However, in the majority of European Union member states, the compliance with corporate governance codes is not legally binding. So while both voluntary and legally binding approaches have certain similarities, codes are generally more generalized, meaning that they allow companies to form their own goals. Consequently, the effectiveness is somewhat limited because there are virtually no mechanisms in place for holding non-compliant entities accountable. And this can also very often result in a symbolic effort to corporate governance. Anti-corruption disclosure is now acknowledged as a critical element of a non-financial disclosure. It is recognized as pivotal in the fight against corruption with corporate governance. High-quality anti-corruption disclosure should assist companies in achieving improved corporate governance and accessing new investments, as well as fortifying relationships with stakeholders. The level of a company's anti-corruption disclosure is associated both with the environmental context and national level factors. This is in line with the notion that a robust regulatory and institutional framework at the national level is crucial for achieving higher levels of corruption disclosure and reducing corporate corruption. Several studies demonstrate that. Companies from countries with lower corporate governance standards are more likely to engage in bribery when exporting their goods and services. Prior studies often also offer insight into how codes of good governance address integrity issues in the EU. So a study from 2013 revealed significant deficiencies in European corporate governance codes concerning the emphasis placed on ethical values, management integrity, and accountability mechanisms. The main objective of our research was to analyze the extent to which the codes provide explicit directives concerning key dimensions of anti-corruption efforts, and these key dimensions were tailored according to the 2030 Agenda of Sustainable Development, as well as other relevant European directives, which touch upon a topic of combating corruption within the EU. In our analysis, we've compared how codes vary in different European countries and highlighted their key similarities and differences. So for the purpose of our research objective, we've analyzed 27 codes of best practices, so codes of all EU member states, which can be found in the database of corporate codes by the European Corporate Governance Institute. And the before mentioned key dimensions are conceptualization of corruption, measures against bribery, combating money laundering, approaching conflicts of interest, transparency in reporting, and whistleblower protection. We then structured our data in a way that allowed us to see patterns and recognize similarities. Here is a table with our results. I've split it in 3 slides, and I'll move through the slides as I speak so that you can maybe focus on a country that you're particularly interested in, even if I don't mention it. Starting with conceptualization of corruption, the approach varies significantly between countries. So you have countries like, for example, Bulgaria or Latvia, Lithuania, where corruption is explicitly addressed, and codes of corporate governance require companies to report on anti-corruption strategies in various types of non-financial reports. And on the other hand, we have countries where there's complete omission when it comes to corruption as a term itself. So some type of a conclusion would be that the approach truly ranges from very detailed and very specific to virtually non-existent at all. A similar thing can be said for bribery measures and anti-money laundering measures. So our analysis highlighted significant variations in how countries incorporate anti-bribery measures. Again, some countries are very explicit, while others barely mention bribery at all. However, when we speak about these two dimensions, we can argue that there is a high probability of a larger, broader legislative framework already in place. When it comes to conflicts of interest and reporting transparency, these two dimensions are addressed in virtually every code of corporate governance in the EU. And whistleblower protection, so our final dimension, is addressed in a few codes. So here is a space where we could recommend some improvements. The key findings of our research are as follows. So transparency in reporting mechanisms is most consistently addressed across codes, which brings us to the conclusion that emphasizing the importance of timely and accurate disclosure of financial information, as well as adherence to international reporting standards and the establishment of internal control systems to ensure financial integrity are a priority in European countries. There is also a consistent emphasis on the disclosure and management of conflicts of interest within corporate governance frameworks, which we've seen through various measures, such as mandating disclosure by board members, establishing criteria for appointing independent directors, and many others. It is interesting how significant attention to measures against bribery is given in certain countries like Austria, Slovakia, Croatia, and Denmark. And on the other hand, we have no mention of these measures in other countries. Again, a similar thing can be also said for combating money laundering. However, as I've mentioned before, it is safe to assume that there is a broader legislative framework in place already addressing these issues. However, when we speak about the corporate governance framework, there is this significant gap where we believe some improvements can be made. The main contribution of our research is a comprehensive examination of corporate governance codes across European countries, which highlights commonalities and divergences in addressing key anti-corruption measures by categorizing and comparing the data. So the emphasis on transparency in reporting or conflicts of interest, anti-bribery measures, and so on. Our analysis identifies best practices and reveals significant gaps. And it also underscores the variety of approaches across Europe. However, there are several limitations to our research. Our analysis focuses on the explicit mention of 6 dimensions of anti-corruption efforts, meaning that if these dimensions were implicitly mentioned, there is a possibility we haven't detected them in the codes. The analysis also does not take into consideration the legal environment or other soft law measures, meaning that it doesn't fully illustrate the anti-corruption framework of a specific country. Our analysis also does not account for the effectiveness of these governance measures in practice, nor does it take into consideration any forthcoming legislative changes that could also impact the corporate governance landscape. When it comes to further research, we believe that there could be a significant expansion by addressing several key areas. It would be very useful to examine the broader legal environment and soft law measures in each country so that we get a better picture of the corporate governance landscape. Also, assessing the practical effectiveness of the governance measures outlined in these codes could be very useful by using case studies or conducting surveys with corporate stakeholders. And finally, a comparative analysis of how these measures are implemented and enforced across different countries could provide insights into best practices and areas for improvement in anti-corruption efforts. Thank you for your time, and if you have any questions, I'll be here.
Thank you, Ana Maria, for a wonderful presentation. Again, it's always nice to see some empirical data, especially comparative outlook on these issues, especially anti-corruption combat. It's nice to always hear where do we stand and where do other countries stand. And from your conclusion, I can conclude that we will see each other in 2 years' time from now with another research which will expand or will be built around the findings that you presented today.
Yes.
And again, it's my great pleasure to welcome our last speaker, Dr. Emma Mendes-Kugor, co-managing partner at the Divjak Topić Bakhtiarović law firm, one of the leading law firms when it comes to corporate law in Croatia. Emma specializes in corporate IT and public procurement law. She earned both her bachelor degree and PhD degree in commercial and company law here at the Faculty of Law in Zagreb. And today she will give a talk about, at least in my view, very neglected yet very interesting topic of corporate governance at the level of law firms, prompted by some recent digitalization of legal services phenomenon. In her paper, she will also address both, actually, she will address both EU and US perspectives. Emma, the floor is yours. Thank you.
Thank you for your kind introduction, Christian, and congratulations to all the presentations so far. It was very nice hearing you. I look forward to tomorrow. Being fully aware that I am all that remains between you and the rest of the day, I will do my best not to overstep on time. Hopefully you can see my screen. So the topic of today is lawyers and corporate governance. For those of you who don't know me, I am a corporate and commercial lawyer with emphasis on regulatory, which means that I do a lot of items in this last picture, a lot less than the first three, despite what people may think. And it was precisely my work in corporate and regulatory fields of law that have actually led me to what I'm about to present to you today. So, consider lawyers and corporate governance. Where do they meet? What will be the intersection here? The first and perhaps most obvious answer will be that lawyers interpret corporate governance rules, thereby also creating a certain body of practice and helping corporate governance rules develop. This would perhaps imply that the former influences the latter mostly, but that's perhaps not always true. My insert and research into this topic has led me into some very, very interesting findings and conclusions. But before we get into the intersection, I'd like to briefly address both items of our equations. So we start with lawyers. When you Google lawyers, this is the Wikipedia entry. With absolute respect for Miss Helena Normanton, Honorable Barrister, I believe that we could say that the legal profession of today has changed. In a think tank that I form part of, which has the express purpose of connecting generations of now almost senior and pre-retired lawyers with those of perhaps my age and even younger, a colleague made a remark. He said, 50 years ago, when I started practicing, it was unthinkable for one lawyer to make his living off the work of another. Practically unthinkable. Today, we have big law. Some of the largest corporations and global ones that have impact across continents are big law firms that employ thousands of employees across the world. So we're no longer talking about the single lawyer hunched over a stack of papers and going to court with his briefcase. We're now talking about a business. Not only that, the legal landscape has changed so that we now have a situation where the provision of legal services is no longer limited to lawyers. If you look at this picture, the current market of alternative legal service providers is worth more than 14 billion US dollars. So I'd say maybe perhaps, except in suit, alternative legal service providers are no longer alternative. In-house counsel trends are also on the rise. There's significant numbers of employees that now provide in-house legal service to their companies and have nominally just one client. So a very, very different and dynamic surroundings, let's say, for the legal profession. Some would say the legal industry as well. Similar changes have occurred with respect to corporate governance. If there was ever an audience to whom I need not explain the difference between the three, I believe it's this one. Nonetheless, the slide is there merely to encompass the breadthness of the corporate governance framework. As you know, we can consider it in a very narrow sense of the word, taking into account only the governance internal mechanisms within a certain company, and perhaps to Anna Maria's point, those that are covered with current corporate governance codes. But there's also a growing body of CSR and ESG topics that have, according to some, grown into a regulatory tsunami, especially if we consider the EU level. So now that we know roughly what happens on both sides, what's the intersection? Where do they cross, and who influences whom? Of course, lawyers do interpret corporate governance and have a lot to say on how it works practically. But my research has shown that it's not always in the way they think. Also, there is, in my view, a neglected perspective to how corporate governance rule can influence and do influence the legal profession, especially if we have in mind the currently growing ESG framework. So, the first intersection would be lawyers interpreting corporate governance. If I were to ask you what these three companies have in common, perhaps you would know right away. They were some of the largest corporate global scandals in the world. And I'm not proud to say that my profession has played a more or less significant role in each of the three. The Enron scandal involved auditors and accountants as well. There were a lot of questions: where were the lawyers in Dieselgate? And allegedly, Deutsche Bank's or their subsidiary DWS's chief legal counsel resigned at the same time as their CEO after the latest greenwashing scandal. So undoubtedly, legal has a role in this, whether it's in-house or lawyers. For purposes of time, let's focus on lawyers and on Enron specifically. You will recall that it was the early 2000s and that we had a much, much more different regulatory framework than we do now. But still, the aftermath of this, one of the largest fraud and bankruptcy scandals in the world, was twofold when it turns to lawyers. First off, we have the SOX Act, the Sarbanes-Oxley Act. In 2002, this act was passed with the more or less distinct purpose to increase corporate governance rules and transparency. Special obligations were introduced for lawyers representing before the SEC. And also, it was mandated for lawyers to engage in so-called up-the-ladder reporting, meaning that if they knew of certain misguided actions within the company, they should report it to either the chief of legal or to the audit or management board themselves. Namely, this entire scandal sparked a vivid discussion on what is the role of lawyers. Do they just represent clients, or do they perhaps owe a broader social duty? Coming back to ESG, social was already then an important topic. Similar rules were introduced by the American Bar Association in their model rules. For the first time ever, and after a spirited debate, the most holy of holy rules, legal privilege, meaning confidentiality between a lawyer and client, was slightly cracked, in the sense that ABA said if a lawyer knows of misguided givings and if they are aware of wrongdoings, they can report this to outside third parties with the express purpose of preventing further damage to the broader society. We did not have similar developments in Europe after that, but surely you will recall that we have now several good examples of how lawyers should report in cases of, for example, anti-money laundering. Or there's even debate with respect to the applicability of whistleblowing regulations, and most recently, the transparency obligations under the EU lobbying rules. In effect, it is a growing body of not only legislation and soft law, including self-regulation, but also of practice. The second intersection was, okay, how do we secure corporate governance compliance for lawyers? These are some of the recent examples of how the CCBE, the European Council of Bars and Law Societies, and the IBA, the Global International Bar Association, which gathers all lawyers, reported and provided guidance on how the legal profession should tackle corporate responsibility. It has been noted on a wider scale that the legal profession has significant influence on how the standards of today, not only corporate governance, but CSR and ESG will apply. Namely, and firstly, the CCB recognized that there's a growing number of clients, especially corporate clients, that ask lawyers to submit to or co-sign their own corporate governance rules. Lawyers wanting to get the client and to ensure their profit rates remain secure usually sign these without hesitation. But what if there's a conflict? What if something in the corporate governance code of a client conflicts with the lawyer's ethical rules and duties? Also, it's a very tricky and slippery slope when we say that lawyers do, perhaps on a wider scale, owe a broader duty. We will all agree that the securement of ESG causes, as well as the functioning of a legal state, is something that we should all aspire to. But what does that mean for lawyers in practice? Practical governance is what is missing here. This, in the same way that corporate governance codes have helped managing boards and supervisory boards across Europe now and across the world, lawyers should be offered the same. Otherwise, we are in a situation where very broad, currently mostly ethical rules and self-regulation rules offer little guidance. A lawyer should consider the broader aspect of his advice, let's say social and ethical advice, as stands in one of CCBE's soft law mechanism and model law rules. In practice, does that mean that I, as a lawyer, should refuse a mandate if I know that a client is not going to be friendly to environment? And if so, yes, shouldn't I stay and counsel him? For example, in Enron, there weren't many cases of legal direct fraudulent behavior, but the lawyers engaged in something that was legally dubbed later on creative compliance, quote unquote, meaning everything was in the bounds of the law. Clients merely asked whether or not and how to secure compliance. How the legal profession will tackle this still remains to be seen, especially having in mind the current ESG framework that effectively pushes law firms into making very concrete and very specific claims and commitments, especially with respect to the environmental segment of this legislation. The IBA has provided some guidance with respect to law firms. If you recall our first slide, there are law firms now that will be well within scope of, let's say, ESG regulations. Some in the future may be also within scope of some of the corporate governance codes that we heard a little bit about just now. But these are guidelines. In the sense of the IBA, it is explicitly said that each firm should decide for themselves, meaning each lawyer is to decide. But the trends are diversing as we speak. In 2007, UK was one of the first countries in the world to address the so-called alternative business service model or multidisciplinary practices. I don't know if you come across the term so far, but their purpose is to provide non-lawyers with the opportunity to engage in ownership and stakeholdership of law firms, while MDPs allow for the providing of both legal and non-legal advice within one roof, so to say. A true one-stop shop, meaning, for example, a client could come into one firm and get both EU funds consultations and accounting and also legal services. This, you can imagine, raised a lot of eyebrows and a lot of questions. The Solicitors and Barristers Association in the UK were adamant that there are specific ethics rules that would either prohibit this or make it very difficult for lawyers and non-lawyers to coexist. What about privilege? What about confidentiality? What about ethics duties? How will we do this? So the Legal Services Act introduced separate corporate governance mechanisms in order to tackle this. Certain services remain reserved for lawyers, while for others in MDPs and ABS, a certain board structure is mandated so that all these need to have a central head of legal function as well as head of accounting and finance. These are some of the examples of how we could expect these regulations to develop further. In conclusion, the research has shown that there is much more to do in the intersection of these topics than perhaps can be seen at the onset. And that it is my sincere hope that this research would show that this is the case and perhaps open up the legal profession into becoming subject to the broader corporate governance framework. I believe that we have much to learn from each other and that the legal profession would greatly benefit from this. That was it for me. Thank you very much for your attention. These are my contacts in case any of you will want to reach out for any additional info or comments. Thank you once again.
Thank you, Emma, for a wonderful presentation. I hope our colleagues from the legal practice have heard everything you said. And I would really like to hear more from their perspective. Where do we stand when it comes to CG implementation into law firms? But I hope you will have time to address that in the Q&A section. So thank you all once again for your wonderful presentations, very inspiring, and for sharing with us, especially your ideas and your critical points about the topics of your presentations, of your papers. Now, I'm really happy to see a couple of questions in the chat box, and since they are quite long, I've tried to summarize them in the order of appearance. So for Matej Trkanec, Professor Horak essentially asks, how do Croatian banks also address greenwashing, notably in light of the BNP Paribas case? So Matej, if you can also tackle upon that. Then we have a question from, again, Professor Horak, if I'm not mistaken, addressing our colleagues from the Faculty of Economics, Anna Maria, Professor Tiporic, and Lana Cindric. So essentially, she was commenting on the scope of codes of ethics and CG codes with regard to anti-corruption practices. And she was kind of wondering if Anna Maria can touch upon the interplay between the two. And last question by Ivan Robachenko was actually, again, to Anna Maria, asking essentially what was their perspective when they were doing their research, their empirical analysis, comparative analysis, when it comes to the conflict of interest, whether they took a more narrow approach or a more broader approach, including also related party transactions. So Matej, the floor is yours, and then we will continue with Anna Maria.
Thank you, Christian. Thank you, Professor Horak, for the question. I'm actually quite happy that I managed to catch your question a little earlier, so I had some time to prepare. As your question is incredibly complex to answer. I'm going to just say that there is a formal answer and there is a realistic answer to your question. Formally speaking, banks currently have very different divisions that are created to deal with these sets of problems. Now, to determine what exactly is greenwashing, to analyze the certain information that were presented during the carbon footprint profiling concept. However, What we at this point do not know is how exactly proficient are companies at lying to us. This is something that I do not believe anybody has a very correct answer, because companies are very proficient at lying, unfortunately. They know how to mask something that they can tell us. This is a perfect example for us. We're going to implement solar panels on, let's say, Vis. It has the most sunny days to go for it. We say perfect, excellent. But what we do not take into consideration is that they are doing it on a land that is, let's say, determined as a cultural good, for example. It's a bit of a caricature, but you get the gist. Here's the thing. We have these divisions that deal with this, but we do not have the necessary knowledge and techniques to delve very deeply into these sets of problems. Yes, I completely agree. Green and sustainable is determined very definitively. The Loan Market Association 2018 gave direct guidelines for credit institutions, what they should look out for and how they should act. And this is the formal concept. We have divisions that deal with this, and we have taxonomy in place, and we have procedures that deal with this. This is the formal concept. Now let's get back to realism. Nobody is dealing with this. Nobody. Nobody is dealing with this either at all, or if they are not able to deal with it in the amount that they should. Why? Banking is unfortunately the most regulated area of entrepreneurship anywhere. We are currently dealing with such a variety of issues that have never been relevant for the banking sector. Now, let's put aside consumer protection, which has became so big, became so actually enormous that it stopped protecting the consumers. It stopped being its initial function of protecting the consumer from the bank. It became something that the consumer is a god that must not be touched, and this is something that is hindering a possibility for normal business conduction. Second of all, we have resilience directives currently that we have to implement. We have the DORA regulation that is going to be in place from January 15th. We have to deal with technological advancements. We have to deal with payment service directives that are constantly changing. The Basel III directive is also going to make structural changes. Now, when you take into consideration the amount of legislation that we have to comply with on not a yearly basis, but a monthly basis, unfortunately, everybody says, what, we have to now deal with some kind of greenwashing or green concepts? No, we don't have time for this. That's a division, they're going to deal with it. Unfortunately, that's the reality. Formally, yes, we all deal with it. Formally, yes, we all do things together with HROK, with everybody, to have a unified ESG questionnaire. But the fact is, we still don't know what to do with that information. This information is not relevant to us at this specific point. Maybe in the near future, maybe when legislation becomes a little more stable, maybe when things in the environmental sense become more drastic, maybe then we're actually going to have something more to do. The thing that I'm most afraid of, and I believe this is what's going to happen, our national legislator is going to say, oh, look, we have to deal with greenwashing. Let's enact a new law. Let's impose another regulatory requirement for the banks. And that's the point where we're just going to do what we do best. We're going to adhere to the new law. We're going to comply with it. And then we're going to basically just do what the legislator tells us. This is bad. Because if you pile legislation one on top of another continuously, you're going to find yourself in a situation where you have two separate regulations, one saying you can do something and the other saying you can't. And then let's not forget, we have national regulators, the Croatian National Bank, HANFA, and so on, which sometimes have a very interesting tendency to give very unique definitions of legal decisions, of judicial decisions, of regulation, which sometimes doesn't even have anything to do with what the regulator actually wanted to say. So in that case, greenwashing is not a second or third instance that we're dealing with. It's about 10th, 11th, or even 15th row somewhere down the line, unfortunately.
Thank you very much, Mate, for your answer. I really appreciate this part of a realistic answer, because that's the case at the moment as we see. I really read into deep regarding the BNP Paribas case. So there were serious allegations, and really that is a quite big reputational risk. So we see as a whole action, we see that BNP Paribas, for example, have invested enormous amounts in this green, that green, etc., etc. So that's the post festum, and usually it is much better to do things ex ante. So maybe really also in this case, this one-size-fits-all approach is not working. So maybe each bank, beside the fact that is highly regulated, will have to adopt its own, let's say, step-by-step, I don't know, internal procedure to know how to evaluate. Maybe European sustainability reporting standards, scope 1, 2, 3 especially, will help in this case. But at the moment, I fully agree with you that this is the reality is this is the last 10th, or how you say, 10th or 11th topic on agenda. Thank you very much.
You're welcome.
Thank you, Mate, for your answer. And now we are moving to Anna Maria.
Thank you, and thank you, Professor Horak, for your question. I absolutely agree with everything that you've said. Our colleagues can see it in the chat. So these anti-bribery measures are addressed more individually in codes of ethics. However, when we started thinking about our research, we started with looking for certain keywords in codes of corporate governance across Europe, and we've noticed that there are several codes that explicitly mentioned these terms. And then when we started working on our analysis, we wanted to have a concrete dimension, and concrete dimensions on corruption. It would feel hollow or shallow not to include bribery, anti-money laundering, and so on. And so we've decided to go down this path, and then seeing how certain countries have addressed these issues, even in corporate governance codes, was very interesting. Now, in hindsight, we could have maybe gone even deeper in this analysis and made a division based on which countries included which dimensions more and which dimensions less, because we've seen specifically with anti-bribery that certain Slavic countries have been maybe more inclined to include these things in their codes of corporate governance than some other Westerner European countries. So this is a very interesting thing, and it's definitely something that we could have expanded more on, but it's also an opportunity for perhaps further research. So thank you for your comment. I'll answer the question from a colleague, Ivan, about the concept of conflict of interest. Again, it's kind of difficult to answer whether it was broad or narrow, because we've included every specific guideline in the codes of corporate governance, which included the keywords conflict of interest. This is one of the limitations of our research. So we've gone with specific terms. So if it was mentioned as conflict of interest, we've included it. However, if it was implicitly mentioned in a different guideline, or if it was combined with several other guidelines, there is a possibility that we haven't detected it. So it's hard for me to say whether it was broad or narrow, but there is definitely more space to also go into depth when it comes to conflict of interest, dividing areas of conflict of interest, and then maybe addressing specifically these various areas. However, this is also room for improvement, and definitely could be a topic for further research. Thank you for your questions.
Thank you. Ivan, do you have any comments on Ana Maria's answer.
Yeah, I just want to thank you for your answer, for answering my question. Yes, that's all. Thank you.
Thank you for asking it.
Thank you all. Of course, we are open for further discussion. If you have any other questions, our other colleagues are students. I forgot to welcome our students, so thank you for being with us today. I hope it was also useful for you. Unless there are additional questions, since we ran out of time a little bit, but we are still rather good for academic standards. I would say that we had a very successful panel, very dynamic. Thank you for your contributions. And now it's my great pleasure to announce tomorrow's, the second conference day. We have 3 panels, each of them dealing with different topics, but still really relevant. So I invite you to join us tomorrow morning. We start at 9 o'clock sharp. First, we're gonna tackle duties and responsibility of board members. Then in the late morning session 4, we will delve into the use of digital technology and artificial intelligence in company law. Very relevant, because especially in the context of very recent adoption of AI Act. And we will wrap it up tomorrow with our thematic session number 5, afternoon session, about new tendencies in comparative company law. We have a wide range of speakers, a gamut of topics relevant for the company law of today's, and we really hope to see you all tomorrow at 9 o'clock sharp. This is all for today. Thank you for being with us, and looking forward to see you tomorrow.